Hi guys, this is just a quick video entry on my blog post, Cyclical Stocks Be Greedy When Others Are Fearful. I'm just going to summarise some of the information for you guys. If you haven't got the time, then you can just listen to this video, or you can, obviously be listening to this video while doing other things. So this is all based on my experience. I've been investing on and off since about 2006, 2007, and I'll talk a bit about my past experience as well as the last 15, 16 months. So basically, I started getting interested in cyclical stocks from reading more into Peter Lynch and his work at Fidelity Investments, and reading his books on cyclicals and rebounds, etc. And then back in the crisis in America, I noticed some of the problems with Ford and GM. And basically, I looked at that, and I didn't really invest. So I didn't reap the benefits of. I think what turned out to be a 20 bagger with Ford. Yeah, it went up 2,000%. So I missed out on that, unfortunately. And I promised myself that I wouldn't miss out on a similar opportunity, and I'd be a bit bolder. So hence being greedy when others are fearful. I'll just take the step and go for it. So yeah. I sold some of my stocks. So I sold some Tesco stocks when I saw that the house builders were in a similar situation. I saw that some of the house builders in the UK were selling at the same net asset value as the stock price was selling at the same price as their net assets. So I thought, well, the price of the valuations of their properties were also depressed because of the market, and probably weren't being treated for their fair value. And also the market had kind of decided that they'd never earn a profit ever again, which is kind of ridiculous based on the share price. So this is what I did. I was looking around for cyclicals, and I chose, because I was looking for a rebound stock, I chose a stock that had the most damaged earnings and low margins. Now that wouldn't necessarily be the right outlook or approach for long-term investing, because you want a company that's going to stick around and have stable, potentially quite fat margins. But in this case, I was looking for thin margins, so that then when they recovered, the recovery would actually boost their EPS growth even more. So I looked at Barrett Developments, and you can see in the chart their earnings went down from circa 75p right down to 5 or 6 pence, something like that, in 2010. I think I started investing in about 2011, and I looked at the fundamentals. Yeah, actually in 2010 it went down to minus 2.9 pence. Yeah, so that's kind of ridiculous, really. They were at 52p in 2008. So yeah, the market really killed them in terms of the share price. It went down from, I think it was something like 900 to, I don't know, 60p or something. I think I started investing around 130p or something. But anyway, so you can see from my statements, the image of the statements, it's gone up. On that image, it's gone up 65% actually. Since making that blog post, it's actually gone up a further 20%. So I've done fairly well on that. But yeah, I just wanted to say that it's still risky. I mean, like right now, these aren't for the faint-hearted investors, because basically it wasn't guaranteed that these house builders were ever going to reverse the situation. Barrett Developments in the UK had some debt, so I did split the investments with Barrett Developments, Persimmon, which is the market leader and from what I know, and Taylor Wimpey. And now these had varying levels of debt, but essentially I was banking on the housing recovery. It's kind of started now. You can see trends. The Home to Buy scheme, which is introduced by the UK government in the early part of this year. There's some kind of confidence coming back into the market. But that's it really. So I was just spotted that trend, and at the moment it's done quite well. In terms of the current situation, these stocks are extremely, I wouldn't say they're overpriced, but they're quite expensive now. In terms of PEs, they're in the high 20s, low 30s range. So I think the market is banking on these stocks producing growth back to earnings up to a similar kind of level. I think that the expectations on Barrett's is I think their last was 8p EPS, and I think they've priced in something like 16 to 17p or something like that. So I guess if they don't hit that, then the stock could fall. From my calculations, I think that if it doesn't make that, if it only makes 13, 14p, 15p, something like that, and it falls, the stock falls by 10 or 20%, it's still not bad. It would still only fall back to the valuation that's there. It would still be up 65%. So it's still relatively decent long-term potential, and I think I'd only sell these stocks if the story changes, which might happen. Okay, thanks.